What causes the most devastating financial recessions? I'm not just talking about a bubble bursting, I mean a full blown financial crisis that shakes economies to the core. Think of the 2008 financial crisis when mortgage delinquencies skyrocketed by an astonishing 657%, leading to an implosion of the banks like Lehman Brothers, which faced total losses of 691 billion. Or consider the Great Depression when 25% of the workforce was unemployed and those lucky enough to keep their jobs endured wage cuts averaging 42%. Imagine waking up to the stock market crash, watching your investments plummet, and see your savings at risk. It's terrifying, and it has happened before. They are clear warning signs that often predict a financial crisis. From the asset bubbles to bank defaults, history leaves us clues. In this video, I'll share the key signs that a financial meltdown might be looming, and more importantly, what you can do to protect yourself. Hi, my name is Kevin Baldwin, and if you want the unvarnished truth about finances, this is the place for you. If you find this video helpful, insightful, and packed with actionable tips to your safeguard yourself against the next financial crisis, do me a favor, hit that like button and subscribe, or leave me a comment and tell me what you think. Are we headed for another major financial crisis, or is it just another recession on the horizon? What's the difference between recession and financial crisis? Now, let's start by breaking down what we're really talking about when we mention a financial crisis. I am not referring to your everyday recession or busting of the asset bubbles. As bad as those can be, I'm talking about a real financial crisis, event that can devastate entire economies and alter the global financial system. There's a big difference between a recession and a financial crisis, and understanding the difference is crucial. A recession is when the economy slows down, often defined by two consecutive quarters of negative GDP growth. It's painful, but it's generally short term, and central banks and often ease the situation by lowering interest rates, which spur the economy activity. A financial crisis, on the other hand, is a complete breakdown. Banks fail, markets crash, and the government intervention becomes a desperate attempt to stop a free fall. So, what exactly triggers a financial crisis? Much like an investment bubble, it often starts with inflated asset prices. But what turns the bubble into a financial meltdown is debt fueled speculation. Take the 2008, for instance. Real estate was booming, and everyone believed home prices would only go up. People bought homes with easy credit, and eventually, when the prices plummet, they couldn't pay back their loans. This is a key difference between a regular bubble bursting and a financial crisis debt. And it's not a new story. The Great Depression in 1929 followed a similar path, but instead of real estate, it was stock prices and soaring irrational high prices. People borrowed money to invest in stocks, and when prices collapsed, they had no way to repay the debt. This cycle repeats throughout history. Whether it's a tech stock in 1999 or a real estate in 2008, the signs are often the same. Speaking of bubbles, let's go back to one of the earliest examples, the tulip mania in the 1600s. At the height of the craze, tulip bubbles, yes, flowers, were seen as a symbol of wealth, and their prices skyrocketed. People started buying future contracts for tulips, speculating on what their price would be in the future. Eventually, the bubble burst. Now, the tulip bulbs may seem trivial compared in today's financial markets, but the lesson here is timeless. Speculation can drive irrational behavior and inflate prices, setting the stage for a financial disaster. In the modern era, this speculation continues. Whether it's gold, Bitcoin, or stocks, speculation fuels these bubbles. And while a bubble doesn't always lead to a financial crisis when combined with excessive debt, it can be the spark that lights the fire. So, how can you spot these crises before they happen? One of the tools we have today is the leading economic index, the LEI, which is put out by the conference board. This index has 10 components, and they are typically solid indicators of upcoming recession. But financial crises are harder to predict. Look for shifts in the market confidence. In the lead up of 2008, there was an overconfidence in the housing market. People believed home prices would never fall, and the banks lent money to anyone with a pulse. The same was true during the Great Depression. The margin trading allowed people to borrow money to buy stocks, and when those stocks crashed, the debt was unpayable. Let's take a closer look at speculation because it's often the root cause of the bubble. When everyone and their neighbor is telling you to buy an asset, whether it's Bitcoin, tech stocks, or real estate, it's a clear sign that a bubble may be forming. And when the dumb money, the latecomers who didn't really understand what they're investing in starts piling in, that's your sign to be cautious. Recognizing these bubbles isn't as hard as you might think. Think back in 1999 when everyone was buying the tech stock companies with no profits and no clear business models were being valued as if they were the next Microsoft. People sitting in coffee shops and bars were talking about their latest stock picks and their hype was overwhelming. But the fundamentals were there and eventually the bubble burst. Now here's where things get dangerous. Debt, it's not just about people buying overvalued assets. It's about how they're buying them. When people borrow money to invest in something speculative like real estate in 2008 or stocks in 2029, they create a ticking time bomb. When asset prices drop, they can't repay their loans and the entire financial system's at risk. In 2008, rising bubble burst and the millions of homes went into foreclosure. Banks collapsed and the global markets tanked. But the underlying issue wasn't just that home prices were too high, it was that people had taken on too much debt to buy them. And when prices fell, they were stuck. Let's talk about how financial bubbles burst in hindsight. The signs are always clear. For instance, in 2029, buying stocks on margin with borrowed money set the stage for disaster. When the market opened on Black Tuesday, there were no buyers, only sellers trying to get out. The result? A complete financial meltdown. Similar to 2008, risky lending practices like ninja loans on income, no job, no assets created a housing bubble. When the bubble bust, millions of homes were foreclosed. Delinquency surged by over 600%, and the economy spiraled into the worst recession since the Great Depression. So, what can we learn from these past crises? History is full of lessons. If you choose to pay attention, speculation drives bubbles, the debt transforms those bubbles into full blown financial crises, and yet, time and time again, we see the same mistakes being made. Can we predict the next financial crisis? Probably not, but we can certainly look for the warning signs like speculative buying, excessive debt, and inflating those asset prices. The financial crisis of tomorrow will follow with similar pattern to those in the past. Now let's talk about how to protect yourself. There are two key strategies: diversification and managing your debt. Always diversify your investment. Don't put all your money into one asset class, whether it's stocks, real estate, or Bitcoin. Diversification helps reduce your risk and ensures that if one market crashes, you don't lose everything. And avoid taking on too much debt. Debt is what turns a recession into a financial crisis. If you're buying a home, make sure you can afford it and don't stretch yourself too thin, assuming that the prices will always go up, and never borrow money to invest in speculative assets like Bitcoin or stocks. Your best defense against financial crisis is financial literacy. Educating yourself about how markets work, how to spot bubbles, and how to manage risk will keep your head off the curve. Read the classics like Think and Grow Rich. Study from successful investors like Warren Buffett. Approach their portfolios by increasing your financial literacy. You can make informed decisions and protect your wealth. Speculation creates bubbles, debt transforms them into financial crisis, and financial literacy is your shield. History always repeats itself. The next financial crisis is a question of when, not if. But by preparing now, diversifying your portfolio, managing your debt, and staying financially literate, you can avoid the worst of the damage when it happens. If you enjoyed this video and want to learn more about what happens before a financial crisis, make sure to check out my other videos. Don't forget to like, subscribe, and share your thoughts in the comments below. Thanks for watching.